Most people went to bed feeling fine. Same job, same savings, same plans. And then they woke up poorer. Nothing was stolen, no crash alert, no sirens. Just one policy decision, signed quietly. And suddenly, life felt more expensive everywhere. This isn't a theory. It's happened before, and it's happening again right now. Because modern money doesn't lose value slowly. Sometimes it slips, all at once. Here's why this matters today. Governments around the world are under pressure. Debt is high, growth is weak, and voters are angry about prices. So policymakers look for something fast, something invisible, something that doesn't require raising taxes tomorrow. They find it in one place: interest rates, and more specifically, how money moves through them. Let's strip this down. Imagine the economy as a giant set of pipes. Money flows through them, to banks, to businesses, to workers, to savings accounts. Interest rates control the pressure in those pipes. When rates are low, money flows easily. Borrowing feels cheap, spending feels painless. Asset prices rise. When rates go up, the pressure changes instantly. Loans reset, mortgages adjust, business credit tightens. Governments suddenly owe more on the same debt. Here's the part people miss. The decision itself takes minutes. The effects hit millions overnight. A central bank raises rates by 1%. That sounds small, technical, boring. But on trillions of dollars of debt, 1% isn't small. It's massive. Households feel it first. Credit card interest jumps. Variable rate loans get heavier. New mortgages become unreachable. Then businesses. Expansion plans pause. Hiring slows. Layoffs quietly start. Then governments. Debt servicing costs explode. Budgets tighten. Public spending gets squeezed. Nobody announces you are now poorer, but purchasing power drops anyway. There's an uncomfortable piece of math hiding here. When interest rates rise faster than incomes, real wealth falls. Even if your salary stays the same, even if inflation headlines look calmer. You're not imagining it when life feels tighter. Now, here's the irony. This policy is often sold as protection, a way to fight inflation, a tool to stabilize the economy. And sometimes it works. But in debt-heavy systems, it creates a strange paradox. The cure makes everything feel worse before it gets better. Sometimes much worse. Assets fall, stocks wobble, housing freezes. People who already own wealth can wait it out. People who rely on wages can't. That's why the same policy can feel responsible on paper and brutal in real life. And here's where hype collides with reality. You'll hear phrases like soft landing, temporary pain, necessary adjustment. What you won't hear is how fast confidence breaks. When people feel poorer overnight, they spend less immediately. That slowdown feeds back into the economy. Growth weakens, tax revenues fall, governments borrow more, which increases pressure on interest rates again. A loop. This is why one policy decision carries so much power. It doesn't just change numbers, it changes behavior, fear, timing. And timing is everything in economics. Zoom out and the risk becomes clear. We've built a global system that runs on cheap money. Decades of it. Debt stacked on debt. Raising rates in that world is like tapping the brakes on an overloaded truck going downhill. You have to do it, but too hard, too fast, and control disappears. Lower rates feel good, but create bubbles. Higher rates restore discipline, but punish everyone at once. There's no painless option left. Which brings us to the uncomfortable question. If a single policy move can make millions feel poorer overnight, how much room do policymakers really have left? And what happens the next time they need to pull that lever again?